Welcome to a special financial reality show edition of Where Did My Money Go? Today, we are cracking the #1 mystery of getting your first job, the classic case of the shrinking paycheck.
Okay, just imagine this for a second. You worked all week, you were awesome, and you know for a fact you earned a solid $500. But then your paycheck shows up, and it's only for $420. What? Where did the other 80 bucks go? Did someone mess up? Nope. Let's get our detective hats on and investigate.
So, to solve this little mystery, we need to bring in our two main suspects. These are the things that take a little piece of your pay before it ever even gets to you. So, get ready to meet deductions and withholdings. Okay, our first suspect is called deductions. A deduction is pretty much what it sounds like. It's any money that gets subtracted from your gross earnings. Now, gross earnings is just the fancy term for that big starting number, our $500. After the deductions are taken out, what's left over is your net pay. That's the cash you actually take home. Now, here's where it gets interesting. Deductions actually come in two different flavors. First, you've got your mandatory deductions. You can think of these as totally non-negotiable. Things like taxes that, you have to pay. But then you've got voluntary deductions. And these are the ones you actually choose to pay, like if you sign up for your job's health insurance or you decide to put money into a retirement plan. All right, let's move on to our second clue. Now, this one is tied directly to those mandatory taxes we just mentioned, but here's the twist. It's something you have a little bit of control over. Let's talk about withholdings. So, withholdings are basically the estimated amount of taxes that get taken out of each paycheck. And how does your boss know how much to take out? Well, it's all based on a super important form you fill out when you get a job, called the W-4. This form is basically you telling your employer, hey, here's my situation, so here's about how much tax you should probably set aside for me. So how you fill out that W-4 is really, really important. For now, probably the biggest thing that's going to determine how much gets withheld for taxes is your filing status. Are you single or are you married? Believe it or not, that one little piece of information can change the math quite a bit. All right, quick pause here. Thinking back to those voluntary deductions we talked about, what's one you might actually want to sign up for at a job someday? Maybe a retirement plan to get a head start on saving for the future? Just something to think about. Okay, team, we've interviewed the suspects. We've gathered all the clues. Now it's time to see exactly where that money went. Let's solve this thing once and for all. Okay, let's lay it all out. We start with the full amount you earned before anyone took a penny, $500. That's your gross pay. Let's think of it as a whole pizza pie, fresh out of the oven. And boom, there goes the first slice. Remember those voluntary deductions? Let's say you decided to sign up for health insurance through work, and that costs $30 from this paycheck. That's the very first thing to come out. But wait, there's more. Next up, the government needs its piece of the pie. Here comes that mandatory tax withholding, which we know is based on your W-4 form. For our example, that's another $50. And just like that, another slice is gone. And there you have it. You start with $500 gross pay, you subtract the $30 deduction and the $50 withholding, and what are you left with? $420. That is your net pay, the actual money you get to take home. The case of the shrinking paycheck is officially closed. So, after all that detective work, what's the big takeaway here? Well, it's all about knowing the difference between the money you earn and the money you actually see in your bank account. So, let's lock this in one more time. Gross pay is the big number, right? The whole pie. Deductions and withholdings are simply the slices that get taken out for things like taxes and benefits. And what's left over? That's your net pay, the money that is truly yours to spend. And I want you to remember this. Understanding where your money is going isn't just about solving some math problem. It is the very first, most important step to being in complete control of your financial life. And now you know.
All right, welcome back. Today, we are going to crack the code on a key number you see on your paycheck, state tax. Now, it might seem a little complicated, but I promise, by the end of this, you'll know exactly how it works and what it means for your money.
So let's kick things off with a question that might sound a little weird. Does your actual home address affect how much money you take home? It sounds kind of strange, but the answer is a definite yes. Let's dig into why that is.
And that reason, well, it all comes down to one thing: state income tax. This is the first and most important piece of our puzzle.
So what even is state income tax? Well, it's pretty much what it sounds like. It's a tax that your state charges on the money you earn. But, and this is the critical part, The rate is totally different depending on where you live. Just look at this map. If you're in California, the top rate is a hefty 13.3%. But if you live right next door in Arizona, it's only 2.5%. I mean, that's a huge difference in your take-home pay.
And then you've got this other group of states, like Texas, that charge, wait for it, zero, nothing, no state income tax whatsoever. So the bottom line is pretty clear. Where you live has a direct and sometimes massive impact on how much of your own salary you actually get to keep.
Okay, so how do they actually calculate this stuff? Let's crack the code and walk through a really simple, straightforward example.
All right, let's meet our first example, Alan. He lives in Ohio, and he earns $58,500 a year. Now, Ohio's state income tax is 3.07%. So our mission is to figure out exactly how much money is withheld from his salary for state taxes over the course of 1 year.
And you know what? The formula for this is actually way simpler than you might think. It's just 3 steps. You grab the annual salary, you change the tax rate from a percentage into a decimal, and then you just multiply those 2 numbers together. That's it.
Okay, pay attention because this next part is the most critical step in the whole thing, converting the percent to a decimal. It's super easy. All you do is take that decimal point and just, whoop, slide it 2 spots to the left. So 3.07% becomes 0.0307. If you can get this step right, the rest is a piece of cake. So we multiply Alan's salary by that new decimal and bam, there's our number, $1,795.95. That's the total amount withheld for state taxes for the whole year. See? Pretty straightforward.
All right, that was easy enough for an annual salary. But what happens if you're like most people and you don't get one big annual paycheck? What if you get paid every couple of weeks?
So, let's take what we just learned and level up, because now we're going to tackle a much more common situation, the bi-weekly twist.
Okay, next up is John. He lives in Colorado, where the tax rate is 3.63%. But here's the catch. We don't have his annual salary. We only know he makes $1,234 bi-weekly. And that one little word changes the entire game.
You know, this is a spot where a ton of people get mixed up. Bi-weekly means you get paid every 2 weeks, which means over a full year you get 26 paychecks. It's not the same as getting paid twice a month. That would only be 24 paychecks. That number, 26, is the magic key to solving this whole thing.
So because of that, we have to add a brand new step at the very beginning. Before we even think about touching the tax rate, we have to figure out John's annual salary. And to do that, we just multiply his bi-weekly paycheck amount by those 26 pay periods.
You run that quick multiplication, and there it is, $32,084. That's his total annual salary. And now, we finally have the number we need to work with.
And from this point on, it's the exact same thing we did with Alan. We take that annual salary, multiply it by Colorado's tax rate, once we've converted it to a decimal, of course, and we get our final answer, $1,164.65 taken out over the entire year.
Okay, let's take a step back and just look at what we did. In just a couple of minutes, you've picked up a super practical financial skill that you can actually use.
So let's just quickly recap the main takeaways here. First, and most importantly, where you live really matters. For annual salaries, it's simple. Just multiply by the tax rate. But for biweekly pay, you always have to find that annual salary first by multiplying by 26. And yeah, some calculators can handle percentages directly, but knowing how to do that decimal conversion yourself is a skill you'll want to have. So from now on, when you look at your paycheck, you're not just going to see some random number deducted. You'll actually understand where it comes from, how it was calculated, and why. You now have the tools to decode a really important part of your financial life.
You know, there's one myth about personal finance that causes so much unnecessary stress, and today we're going to talk about it. It has to do with taxes and the fear that getting a raise could actually leave you with less money. Well, let's bust that myth once and for all.
So here's the question that keeps people up at night. Have you ever thought this? You get a fantastic raise, you're excited, but then this little voice in your head asks, uh-oh, does this bump me into a higher tax bracket? Am I actually going to lose money now? It's a really common fear. And here's the myth behind that fear. The idea is that if you move into, say, the 25% tax bracket, your entire income, every single dollar you earned all year is suddenly taxed at that 25% rate. Well, I'm happy to report that is absolutely 100% not how it works, not even close. To really get it, you have to completely ditch the idea of a single tax rate. Instead, I want you to picture something else. Think of your income as filling up a series of tax buckets.
Okay, I know this table looks a little complicated, but the concept is super simple. Just imagine your income is like water. You start filling up the first bucket. That bucket has a low tax rate. Once it's totally full, the money spills over into the next bucket, and only the money in that bucket gets taxed at the next, slightly higher rate, and so on and so on.
Now, this whole bucket system has an official name. It's called a progressive tax system. And the name kind of gives it away, right? The tax rate progressively gets higher, but, and this is the key, only for the new layers or buckets of your income.
All right, enough theory. The best way to understand this is to see it in action. So let's walk through a real-world example together and actually fill up those buckets.
Okay, so let's take a look at our example person. They're a single filer and they make $47,500 a year. We're going to use the single person table you see here to figure out exactly how their income fills those tax buckets. So first things first, we got to find which bucket their income stops in. An income of $47,500 lands them in the range between about $37,000 and $87,000. So their highest tax rate is 25%. But look closely at the wording, because this is everything. It's 25% of the excess over $37,500, not 25% of the whole salary.
So we can break this down into a really simple four-step plan. First, we'll find out exactly how much money is spilled into that top 25% bucket. Second, we'll tax just that amount. Third, we'll grab the tax from all the lower buckets that are already full. And fourth, we'll just add it all together. Let's do it. Okay, step one, we take their total income, $47,500, and we subtract the starting point of that top bucket, which is $37,500. That leaves us with $10,000, and this is the magic moment right here. Only this $10,000 is going to get taxed at that 25% rate, just that little bit at the top.
Step 2 is nice and easy. We just take that $10,000 and multiply it by its tax rate, 25%, and that gives us $2,500. So that's the total tax from just that highest bucket their income reached.
But wait a minute. If you look at the table, there's another number in that row. It says there's a base tax of $4,867.50. So what's that all about? Where'd that come from?
This is the brilliant part that makes it all so easy. That base amount, that's the total tax from all the lower buckets, the 10% bucket, the 15% bucket, already calculated for you. It's the tax on the first $37,500 of their income, all wrapped up in a neat little package.
And now for the grand finale. We just put the pieces together. You take the $2,500 in tax from the top bucket, add it to the $4,867.50 from all the lower buckets, and you get a total federal tax of $7,367.50. See? When you break it down like that, it's not so intimidating, is it? So now that you're a pro at the whole bucket filling logic, let me show you the shortcut. The tax table actually gives you a little formula that does all this thinking for you.
All right, let's bring in our friend Randy. Randy's also single, but he earns a bit more, $57,500 a year. He's actually in the same tax bracket, so we can use the formula from that same row to figure out his tax way faster.
And there's the formula, right there in the table. The tax is $4,867.50 plus 25% of the excess over $37,500. Sound familiar? It should. That's literally just our four-step bucket process written out in one line.
So you just pop Randy's salary of $57,500 into that formula, do the quick math, and boom, his total annual tax is $9,867.50. The formula's fast, yeah, but what's really cool is that now you know why it works. You see the buckets behind the calculation.
So we've gone through the myth, the logic, and the math. What's the one big thing you absolutely need to walk away with? Let's nail down the big takeaway.
Let's just put the myth and the reality side by side for a second. If the myth were true, our person making $47,500 would owe almost $12,000 in tax. But in reality, with the bucket system, they owe about $7,300. I mean, that's a difference of thousands of dollars. It's huge.
So here it is, the final word, the truth you can take to the bank. A raise will always mean more take-home pay, period. You never, ever lose money by moving into a higher tax bracket. It just means that a small piece of your new money, the money from your raise, gets taxed at a slightly higher rate. That's it.
You've just learned how to read a tax table, which is a financial superpower, honestly. You understand our progressive tax system better than most people out there. So the real question is, what's next? What other financial myths are you ready to go out and conquer?